So in this video we're going to look at the functions of central banks. So obviously there are many central banks in the world, key ones being, for example, the Federal Reserve in the United States, sometimes known as the Fed, the European Central Bank for the Eurozone, the Reserve Bank of India, Bank of Japan, of course the Bank of England in the City of London. So what we're going to look at in this video is the main functions of central banks. Just before we do, it's worth pointing out that banks, central banks, which are very different and completely different to commercial banks or investment banks, central banks carry out these functions and their independence has probably increased. For example, in 1997, the Bank of England was given operational independence for the control of inflation, which meant it set interest rates whilst meeting a target for inflation set by the government. So let's look at these different functions. Of course, the key function, historically important function, is issuing notes and coins, trying to prevent forgeries in doing that, and so therefore being responsible for the money supply. Notes and coins can influence broad money, and through banking you can influence broad money through banking regulation. Okay, so issuing notes and coins, controlling the money supply is very important. Now, a key function of central banks is acting as lender of last resort to commercial banks. So if commercial banks get into liquidity difficulty, look at the video on a commercial bank's balance sheet for that. If they're short of cash, the central bank will intervene to ensure stability in the financial system and also to ensure trust and confidence. But you put your money in a commercial bank, your cash, it's going to be safe and you're going to get it back. So a key point really about a lot of these functions is to provide stability and confidence within the financial system and the economy as a whole. So we've got lender of last resort. The bank will step in to provide liquidity to rescue a bank if it has a liquidity problem in the short term. Okay, so it's lender of last resort, and also lender of last resort to the government. So the Bank of England issues bonds on behalf of the government, and central banks generally do this. They also issue short-term bonds, which are often known as bills, treasury bills in the UK. And these are issued on behalf of the government to finance the government's debt. Sometimes bond markets require a little help, so the Bank of England will buy back bonds if there's a liquidity problem in bond markets, just to smooth out bond markets. So again, the function of the bank is to act as lender resort to provide stability and confidence in those markets. And then we've got the inflation target. So central banks have an increasing role in terms of dealing with monetary policy, controlling monetary policy, in order to affect and have an impact on economic objectives. Now, often governments in the past would control monetary policy, but increasingly banks have become independent. So if you've got an inflation target, the idea is the bank needs to meet, often with members of the bank, to achieve that target. So by setting interest rates, which we'll come to shortly. As well as inflation, of course, you could have a target for growth and unemployment, some general target. And basically the overall key point here is to provide economic stability. And this, what the target is for the bank depends upon the remit of the bank. The Bank of England's remit is principally to meet a target of inflation at 2%, whereas other CPI, whereas other banks have a sort of broader remit. And then of course to achieve that, you could use, in extraordinary circumstances, unconventional monetary policy. So they're responsible for the operation of quantitative easing, and quantitative easing is used to encourage bank lending by commercial banks and to keep interest rates down. See the video on quantitative easing for more detail on that. And the other area of monetary policy that's important, of course, is setting interest rates. So the Bank of England sets the bank rate, and the bank rate affects all other interest rates in the economy. When the bank rate comes down, other interest rates tend to come down to some extent. Yeah. So they follow the same sort of direction, and of course there's often a lagged effect, which is explained more in the monetary policy transmission mechanism video. And then finally we have, again, stability is important, maintaining stability in the financial system. A lot of banks, central banks, have a big role in terms of regulating commercial banks. And that's crucial to maintaining stability in the system. And again, see the video on regulation for more detail on that. So these are the functions of the central bank, such as the Bank of England. Thank you for watching.